Hey, EK fam, Aaron Kane from EK Financial Group here. I've got some exciting news. I'm at the Elston HQ in Brisbane, here with one of the co-founders and portfolio managers, Bruce Williams. And I've got a chance to have a chat with him one-on-one about the current state of play of the markets and about our Weinberg portfolios. So as you know, Elston Asset Management are the guys that have put together our Weinberg portfolios for you, and they're the ones that are monitoring it, maintaining it, making sure that it's at the best of breed investments at all times. So let's start. Bruce, let's start with a quick overview. What is the current state of play in the Australian and overseas markets?
It's pretty interesting. I think on the front of everyone's mind will be Donald Trump. He is creating a lot of uncertainty out there. No one knows quite what he's going to do next and why he is actually doing it. But markets do not really like uncertainty. At the moment, it's based around tariffs, and that's how it affects Australia. And Australia is an export economy. The extent to which it impacts us is unknown at this stage, so we'll just have to keep a watching brief on that. Also impacting the Australian market is we've just been through our half-year reporting season, so companies report at the end of December and at the end of June. So we've just gone through the end of December reporting season.
Cool, thanks for that. So what are the main things we're keeping an eye on this year for the investment outlook?
It's really, if we're talking domestically, the Australian consumer. As you would know, we're in an election year, so that tends to change things up a little bit. But we're very focused on how the companies are going from an underlying perspective. So how the companies going in terms of their end markets. Are the consumers buying? Are the consumers not buying? Are other businesses buying product? Is there reinvestment going on? Reinvestment is very, very important in order to maintain company profit growth, and certainly dealing with the uncertainties that comes through, as I mentioned before, Donald Trump, our domestic election. All of these create variables that you can't really quite factor in now. You can have a view, but certainly for us, underlying company performance and what we're paying for those companies are the two most important things. So if you think about a retailing business, who are their customers? What are they doing? What is the demographic of those customers? Because demographics at the moment are really important. The younger generations are certainly feeling the squeeze. The older generations are actually in a really good position. So how they're going about that, obviously cost of doing business. Everyone talks about household budgets being under pressure. It's no different in the corporate world. If you think about the cost of labor is going up, the cost of regulation is going up, the cost of electricity and all those other things is going up as well, and how they actually deal with that at the company level is really important.
So we bring it back to the Australian share portfolio. So when our clients log into their accounts, they can see brands that they know and trust in there. You guys manage that portfolio. So can you tell us how has the performance been over the last 6 to 12 months in that?
Yeah, it's really it's a tale of, I guess, two stories. In absolute terms, performance has been okay. So that's a starting value here and end value there. That performance has been okay relative to the benchmark, which is how we're judged. It's been very poor, and that's a function of probably the way the Australian index is, in terms of you have about 55% of the index is the top 7 or 8 companies in Australia. Half of those are banks. Now, banks had a standout year last year. They returned very high numbers, but it was all on multiple expansions, so they became more expensive. And that's an environment which we will do very, very poorly. If we think about an investment going up, we think that it is driven by earnings, not multiple expansions. So not companies becoming more expensive. The banks are trading at really elevated multiples, so they are much more expensive than they've historically been. And we don't think that is sustainable. So we expect those banks to come back to the market over time. Why they become more expensive is a little bit of a mystery to us. They are seen as defensive, but we would argue that they're not that defensive. They are very well run. They are very well regulated. I'm not saying they're bad companies, but they are trading at levels higher than we're willing to pay for them. In terms of other parts of the market, we saw really growth companies have similar to the banks, have a lot of multiple expansion, and being very conscious about what we pay for assets. That probably didn't suit us either. So it was really those two sectors that hurt us. What benefited us were the resource companies. They had a very soft year, and resource companies in a way are very simple. If the commodity price goes down, they will earn less. If you think about their cost of production is relatively fixed, when commodity prices are high, they abnormally benefit. When commodity prices come down, they are adversely impacted. And that's what happened last year. So the commodity sector, such as we own BHP, but certainly Rio Tinto is another really big commodity business. That's something we are certainly taking a good look at now that we see commodity prices at more sustainable levels. To give you an idea of quantum, iron ore, which is what Australia exports, massive amounts of, it got to $220 a tonne. It's now back towards $100 a tonne. So cost of production, if you said, say, $15 a tonne, you can work out the margins from there, but it does have a big earnings impact. And they were the largest drag on earnings growth as an index overall last year. But that being underweight that sector positively impacted us. So banks really hurt us, underweight resources benefited us.
Cool. So thanks for that. So in a nutshell, and an easy explanation is you don't want to pay too much for a stock or a company that's overpriced. So what things do you look at when you are looking to put a company into our portfolios? What are you looking at in the characteristics of that fund?
It depends on the type of business they are. If you think every company has its own factors, but certainly what we're looking for is we're looking for whether it is providing us with growth in earnings over time. Remember, we have a 3-year plus time frame, so whether or not those earnings are going to grow, how stable those earnings are. So for a really mature business, a great example might be a Woolworths or Coles. They tend to be quite consistent over time, so you can really model those reasonably easily. What their costs are and how variable they are. So if you think about a cost being fixed versus a variable cost, and a variable cost comes and goes depending on the amount of goods you are selling. So it's the breakdown of those expenses and what those expenses are, whether it's labor or whether it's reinvestment into technology. So again, different costs we look at in different ways. But broadly speaking, we're looking at what the earnings are, how easily they are to model, how simple the business is, what their costs do, which go to margin. So how much money they make on every dollar of goods that they sell. And then we work out what that is worth in terms of what are we willing to pay for that company. If something is really high risk and really variable, we will like to pay less for it. If something is really stable, really high quality business, a global leader, and I might use an example, I'm not sure if any of your customers use sleep apnea machines, but if we talked about a company like ResMed, it is a global leader in the provision of CPAP machines and all the accessories that go with that. They reinvest very heavily back into their product, so they're maintaining their competitive advantage. Their market is only about 10 to 15% penetrated, so they've got a lot of runway for growth. So you look at that and you go, we'd be willing to pay more for a business like that. If you look at something at the other end of the spectrum, something that like the commodity businesses I was talking about before, where they can't control the price of what it is they're selling the good for. They can only really control the cost line. So a business like that, you'd be willing to pay a lot less for. So it changes based on not only the industry it's in, but the individual company. And so that's where experience comes in and a lot of research comes into the process. So it does vary significantly depending on the characteristics of the individual business. But what we saw over the last year, we think that valuation discipline was lost in a lot of sectors. And when you're very conscious about what it is you pay, that can potentially hurt you. But over sort of a 3 to 5 year time frame, it tends to normalize. So what hurts you one year tends to benefit you the next.
Cool. Thanks for the explanation. So we just finished reporting season. So you've been busy reading up on a lot of charts, I bet, and financials coming from all the companies. Tell us any surprises out of that or anything we're looking at now. Is Elston keeping an eye on with the current portfolios moving forward?
Yeah, in terms of reporting season and the profits and the outlook statements that the companies provided, there was nothing really too out of the ordinary there. What we saw during reporting season, which was out of the ordinary, was a lot of volatility in share prices. And that's probably more to what I was just talking about in terms of valuations mattering again. So you saw some companies that produced really good results, but the results were expected, and they're expecting similarly very good results into the future. And it's likely that they won't be quite as rosy into the future, and they got heavily sold off. At the other end of the spectrum, there were companies that produced quite good results when they weren't expected. So more your cyclical or more value orientated businesses, and they were handsomely rewarded. So we think it's an environment going forward that we'll be a lot more comfortable in terms of where, if you think about the inputs to determining what a company trades at is growth and risk, we think that is going to be a lot more important going forward. And that's an area, or that's a time in which I think we're well positioned to take advantage of, because we are very conscious of what it is we pay for assets.
Cool. Thanks, mate. And looking ahead, so what's your expectation? What are your thoughts on the Australian share market moving forward for the next 12 months?
Well, probably if I start at the overall economy and work backwards, the overall economy isn't terrible. Obviously, you see it in the papers every day and on the news every night, cost of living. Certainly, that is an impact. And as I mentioned before, that's very much a demographic question. So your, say, university students all the way up to people who are in their mid to late 40s, costs of your household costs are going up. You've got income growth coming through, which is really good, but that's getting absorbed by not only increased household costs, but also tax bracket creep, which again is we've got the election potentially coming up. It's been talked about by one side of politics, but not potentially the other at the moment. But it is a factor. You know, the tax take is increasing across Australia overall. The older demographics are actually going really well. So a lot of those may be in super. The amount of tax they're paying on superannuation income, and this is more your world than mine, but it's quite low. If you think about more defensive asset classes such as bonds and cash are paying income when historically they haven't paid it, probably over the last 10 to 15 years. So there's more income being generated there. So your older demographic are actually saving as well as spending. Whereas the younger demographic are having to pull back on spending. So we think the overall environment for the market is going to be okay. Where we think you may see some adjustment are around those sectors that we believe are overvalued versus the earnings that they're generating and the amount of risk that they're taking on to generate those earnings. So that's where you'll see changes. Obviously, you have external impacts like Donald Trump, like a federal election domestically. That'll create volatility, but it doesn't really create volatility at the underlying earnings side of things. What it creates volatility is around sentiment to markets, and volatility works both ways. It potentially, if it's unjustified, it potentially gives you an entry point into a security, or it gives you the opportunity to buy more of a security where it's getting unfairly punished for something that doesn't really impact it. So really, the major factor this year will be an impact on sentiment as opposed to underlying company performance. But certainly we think the Australian economy is okay. Wage growth is coming through. Economic growth is a little bit soft, but not terrible. Probably one other thing I might mention is economic growth through the private economy is a little soft because it's getting crowded out by governments. Government spending is huge and growing at a very high rate. And this is state and federal, and it's left and right. It's not a political statement, it's just a fact. You're seeing very strong government growth. If they start pulling back on some of that fiscal stimulus, it may well allow private enterprise to actually take up the reins and run with it. But it may also mean that growth remains a little softer than what is currently expected. So we think the market's going to be a little more patchy than it has been. The effects of COVID are now gone, but certainly we're not totally negative. We're just very conscious around not overpaying for assets. And hopefully we'll be able to use volatility to the portfolio's benefit.
Cool. I can't go without saying, so we just had the federal budget 2 nights ago. So you might touch on it a bit then around cost of living pressures, sentiment in the market. Obviously, there was a couple of things that came out in that, but can you maybe give us some examples or, I guess, comment on the tax cuts that they're talking about that are coming in the extra 1% a year for the next 2 years, energy subsidies and stuff like that? Is that going to help sentiment and cost of living, do you think?
Ultimately, what is paying for those subsidies is tax. So I'd rather they just, for example, got rid of bracket creep, indexed tax brackets, and they wouldn't have to provide us a subsidy because we'd be better off. Probably the bigger issue for mine is longer term, is that the amount of spending at both the state and federal level, and this is pretty much all state governments and federal, is huge, and it's not sustainable. So if you think about the amount of debt that is carried by both state and federal governments, it is huge and getting bigger. It's not huge from a global perspective. Australia is all right, but it's huge versus ourselves historically. There's a lot of big programs that are baking forward costs into the economy, they're the ones growing the fastest. And I think it's a problem that no politician's actually willing to address. I think it's really weak leadership across the board, and I actually personally find it quite distressing. But that's the world we're in. It just means that for every dollar a government raises into the future, a larger portion of that will be on interest costs. At some stage, they will have to address spending, but no one seems to be politically capable of doing that at the moment. And it also means that tax. Australia has a very inefficient tax regime. I don't need to talk to Victorians about all the inefficient taxes that have been put on Victorians over the last 5 years. Land tax, vacant block of land tax, sales tax, payroll tax, all these things. No one seems willing to address those, and it is a problem. It's not a problem so much for this year or next year. It's a longer term problem than that no one's willing to address. But certainly there was nothing, going back to the budget, there was nothing in the budget that was of remote interest to anyone, really.
That's enough of politics. Bring it back to the portfolio. So post reporting season, any likely short to medium changes that are coming out, or anything you've foreseen?
Yep, certainly there were probably 3 or 4 securities that we are implementing changes with at the moment. One that I can talk about. So we've sold Nine Group. They received a takeover offer. They own 60% of Domain, and that is quite a large part of Nine's business.
For people who don't know, Domain is
real estate portal. So you've got, Australia's a country of a lot of duopolies or oligopolies. So if you think about realestate.com.au and Domain, they're the 2 big real estate portals where if you want to sell a property, that's where you put the real estate agent puts them through. You obviously pay for it if you're the selling property person selling the property. You pay for it, but the real estate agents use it to advertise your property for sale. So we've sold Nine and we've bought Seek. Now it's a like-for-like swap if you think about Domain and Seek. So if you're looking for a job or you're an employer looking to hire someone, Seek is the main portal that you use to do that. We're buying that because advertising for jobs has been really quite low for the last period, and we think that'll rebound over time. So they are absolutely dominant domestically. In terms of, there's a couple of other securities that have had a change in industry structure, actually, funny enough, through government intervention. So we're looking very closely at those. We're likely to reduce the weighting to those and redeploy into areas where we've got greater visibility as to what it looks like for them. So when we look at a company, we're modelling forward, as I mentioned previously, 3 years plus. And if you lose visibility on what it looks like for that company due to factors, such as government intervention or a major change in a competitor and a competitor product, it makes it very difficult to work out what it's worth. And so we'll likely reduce weighting to those and add to ones where they don't face those same issues. in terms of portfolio structure, we remain overweight. Our biggest overweight is healthcare, and there's a couple of reasons for that. One, they were badly impacted during COVID. So not only demand, people couldn't go out to buy a CPAP machine, as an example, or the cost of freight and things like that during COVID were really high, and so they got impacted from that side of things. So we think costs will be rolling off, which makes them more profitable. We think demand is non-discretionary. So if you need a blood transfusion, CSL will benefit from that. If you are profoundly deaf, Cochlear will benefit from that. That's not to do with the economic cycle. That's a matter of requirement, regardless of
Aging population.
Aging population. Yep. Unfortunately, we're getting older and fatter, which is sad but true. So again, it's non-cyclical demand. So very stable demand going forward at the time when you got costs rolling off. And they are global leaders in what they do. Australia is very strong in healthcare. If you think CSL, ResMed, Cochlear are all global leaders in what they do. So it's not just Australia, they've got a global presence and good global growth opportunities. So that's a big overweight for us at the moment. It's probably not really adding too much to portfolio returns at the moment, but again, our time frame is three years plus. We think over that time, the investment at reasonable valuations will really pay off for your customers.
Cool. Thanks, Bruce. Final thoughts. So I guess what's one last key message you'd like to send to our clients that are trusting us in their investments and their retirement funds?
Yep. Probably a really simple one, and it's probably more common sense. Don't look at the values daily. We saw a massive amount of volatility during not only January, but February and into March as well. Often that has got more to do with just supply and demand on the markets for an individual security. It doesn't have anything to do with the underlying profitability or value of the security. So that's certainly one thing. The other thing is that we remain very conscious of what it is we pay for assets. We don't like overpaying. A company's got to show us that they're reducing risk, that they're increasing growth, that their balance sheets are strong. Sometimes that means that we're buying things that on the surface of things are unpopular, but that's a good place to go when your time frame is 3 to 5 years. So we're very comfortable with the portfolio. Day-to-day volatility is a thing, but it doesn't worry us too much. But dividends are very solid through the portfolio. You get the benefit of franking credits, which are risk-free return at the end of the day. The team's working hard to try and produce good results, and hopefully over time we do that.
Well, thanks, Bruce. Thanks for your key insights and your time today. Just want to say thanks, guys, for watching. Obviously, I've seen firsthand what the guys here at Elston are doing. The due diligence behind the scenes, managing your money, making the decisions is the best around. So I've all confidence in these guys, and if you've got any questions, please let me know, and I'll happily reach out to Bruce and his team.
Great to see you again, Aaron.
Cool. Thanks, mate.